In 1986, the United States Congress passed a tax reform act that rewrote the rules of the American economy. In a span of exactly 43 days, lawmakers shut down the major loopholes that high earners had used to shield their income for decades. The reaction was severe. Properties previously bought as tax write-offs became immediate liabilities. Real estate values dropped by as much as 70% in some areas. Bank lending froze, Wall Street suffered a historic crash the following year, and corporations initiated massive waves of layoffs, introducing a polite new term for unemployment, downsizing. But if you look closely at the data from that period, the capital didn't evaporate. While thousands of employees and self-employed professionals lost their homes and retirement accounts, a specific group of investors quietly acquired those exact same assets at deep discounts. It is tempting to look at a massive transfer of wealth like this and assume it's the work of insider manipulation. The reality is much simpler. Everyone is playing the same game of capitalism, but they are playing by two completely different rulebooks. The first rulebook belongs to employees and the self-employed on the left side of the economy. When this group interacts with money, their driving motivation is to acquire security. They seek safe jobs, predictable hourly wages, and conventional savings accounts. The second rulebook belongs to business owners and investors on the right side. Their financial strategy is built around acquiring independence. They don't look for wages, they look for assets. When the tax laws shifted in 1986, the wealth moved predictably and exactly from the side of the board optimizing for security straight into the pockets of those optimizing for independence. When a market collapses, fear takes over. People operating on the left side of the economy look at falling housing prices and stock market crashes, feel panic, and retreat to protect whatever cash they have left. Those on the right side rely on financial intelligence, the ability to read numbers and negotiate terms, to analyze the exact same landscape. To them, the 1986 housing crash presented a mathematical opportunity. Because rents remained steady even while property values dropped, the cash flow economics of real estate actually improved. It was the equivalent of a premium department store marking down every asset by 50%. To capitalize on this, investors employ a highly specific tactic. They play the bank. Rather than saving up their own cash to buy things outright, they create equity by controlling assets and leveraging other people's debt. Consider a house with a market value of $100,000. In a distressed market, an investor buys it for $80,000. They put down $10,000 of their own money and take out a mortgage for the remaining $70,000. Then, they immediately put that house back on the market for its full $100,000 value. But they don't demand cash up front. They offer seller financing, meaning the new buyer signs a $100,000 promissory note to pay the investor in monthly installments. The new buyer's monthly payments flow directly to the investor. The investor uses a portion of that money to pay their original $7,000 bank mortgage, pocketing the difference. The risk is effectively offloaded. By bridging the gap between the $70,000 debt and the $100,000 note, the investor has generated $30,000 in equity. They didn't trade $30,000 worth of hours, they structured a transaction. This strategy allows an individual to replicate the spread-based model used by traditional banks, controlling the asset while offloading the underlying debt to the end buyer. Structuring deals is only half the equation. The second major advantage of operating on the right side of the economy involves an entirely different relationship with the tax code. For an employee, the sequence of money follows a rigid path: earn, be taxed, spend. When you collect a paycheck, the government's share is extracted automatically. You only get to live on what survives the siphon. Because your largest expense is taken right off the top, trying to build significant wealth by merely saving your leftover wages requires a mathematical miracle. The financial friction is simply too high. Business owners and investors operate on an inverted sequence: earn, spend, be taxed. Their revenue flows into a corporate entity, fully intact. Inside that corporate structure, they pay for travel, equipment, and operational costs. These are recognized as business expenses. Only after the business has spent what it needs to grow does the government calculate taxes on the remaining fraction of profit. The tax code functions as a system of incentives. It rewards those who build businesses and invest capital, while siphoning revenue from those who only sell their time. Economic cycles follow a predictable rhythm. Booms and busts arrive as a byproduct of timeless human emotions, fear and greed. As these cycles play out, lawmakers will rewrite the rules again. New legislation will be passed, loopholes will open and close, and wealth will shift hands once more. Expecting a single employer or a government pension plan to safely navigate you through these shifts is a relic of the industrial age. That safety net is gone. You can choose to stay on the left side and optimize for security, but the admission price for that perceived safety is surrendering half your income to taxes and relying on consumer debt to maintain your lifestyle. Or you can choose to cross over to the right side and play for independence. Making that jump requires you to train your mind to see what your eyes cannot. You have to learn the language of finance, route your income through protective corporate structures, and acquire assets that pay you while you sleep. In a modern economy, the wealth goes to those who dictate the terms of the transaction. You have to stop being the banker's customer and start acting as the bank.